You know, when you hear about a corporate buyout that's nearly $1 billion, your mind immediately goes to the price tag. But with this deal, USA Compression buying JW Power, that huge number isn't even the real story. Nope. The real story here is about building an absolute empire. This was a calculated move, designed to forge a powerhouse in the energy sector. And believe me, it's about way more than just getting bigger.
So, what's the price for a major shakeup in the energy world? $860 million. That's the number that completely changed the game. But this isn't just about dropping a fortune. It's about how every single one of those dollars was strategically used to reshape an entire industry.
Okay, so who are the big players in this story? Well, on one side, you've got USA Compression, we'll call them USAC, a massive, publicly traded giant in the world of natural gas compression. And on the other side, JW Power Company, a private, family-owned institution with a 60-year legacy. So this wasn't just a simple buyout, it was more like a merger of two industry titans.
All right, let's peel back the first layer of this deal. We'll start with the most obvious part of the strategy, sheer scale. On the surface, this was all about creating an absolute behemoth in compression services. But it's not just about size for the sake of size. Oh no, it's much smarter than that.
Just look at this jump in power. I mean, wow. USC was already a monster with a 3.6 million horsepower fleet. This deal instantly bolts on another 800,000 horsepower from JW. That brings their combined force to a staggering 4.4 million horsepower. That is not just a little bump. It is a massive, massive leap in market dominance.
And here's where it gets really clever. It's not just about having more machines. It's about having those machines in all the right places. This acquisition gives USAC a powerful, ready-made footprint in every single major natural gas basin in the US. We're talking the Permian in Texas, the Marcellus out in the Northeast, and everywhere in between. That kind of geographic spread makes the whole operation way more resilient.
And you know what comes with a bigger map? A bigger customer list. JW Power didn't just bring equipment to the table, they brought over 300 established, high-quality customers, many of whom they've been working with for years. For USAS, that's like getting an instant injection of proven long-term business.
So getting bigger and broader? That makes total sense. But the real genius of this whole acquisition, the secret sauce, lies a little deeper. This is where USC didn't just buy a competitor, they bought a whole new superpower. See, to really get this, you have to understand who JW Power was. They were founded way back in 1960, and they weren't just some rental company. They started building their own equipment way back in '76. This is a company with decades of engineering and manufacturing in its DNA. It's a legacy of building the very things they leased out. And you can see that builder's DNA right here in their business model. Yeah, sure, contract compression was their main gig, about 90%, but that other 10%, that's where the magic really happens. We're talking higher margin stuff like parts, manufacturing, and repairs. And this is the key. USC didn't just buy rental contracts. They bought factories, they bought the supply chain, they bought decades of expertise. And all of that leads to the real secret weapon, total control over the supply chain. By bringing manufacturing in-house, USAC is no longer waiting on some other company for parts or getting hit with surprise price hikes. They can build new stuff faster. They can fix old stuff faster. They've got the parts right there to keep their massive fleet humming along. All of this creates this powerful competitive moat, an advantage that their rivals simply can't copy overnight. It's a game changer.
Okay, so a brilliant strategy is one thing, but it's only truly great if the numbers add up, right? So let's talk about the money. How did USAC structure this deal to be not just strategically sound, but also a really smart financial move?
Well, they split it right down the middle, a perfect 50-50. Half of that $860 million was paid in cold, hard cash. The other half was paid for with USAC's own stock. And that balance is absolutely critical because it reveals the real financial goal of this whole thing.
Now, this might sound a little strange. How in the world do you spend almost $1 billion and end up financially stronger? Well, the key was using their stock for half the deal. Instead of taking on a mountain of new debt, USAC essentially traded a piece of the company for all of JW's assets and earnings. It was an incredibly clever way to get bigger and healthier at the exact same time.
And all of this leads to a term that investors absolutely love, distributable cash flow, or DCF. The easiest way to think about DCF is that it's the company's profit pool. It's the actual cash that's available to be paid out to the owners. This whole deal was designed to be meaningfully accretive,
which is just a fancy way of saying it's going to make that profit pool a whole lot deeper for investors.
And hey, you don't have to take my word for it. You can hear that focus on investors loud and clear from USAC's CEO, Clint Green. The goal wasn't just to get bigger. It was all about creating real, long-term value for the people who own a piece of the company. And on top of everything else, they got it all at a fantastic price. The deal was valued at about 5.8 times what JW is expected to earn in 2026. Now, analysts pointed out that this was a pretty sweet discount compared to what USC's own stock was trading for. So put simply, they bought these incredible assets in a very smart, disciplined way that creates value from day one.
So, let's put all these pieces back together. You've got the massive scale, you've got the secret weapon of manufacturing, and you've got the smart financials. What does the new and improved USA compression actually look like?
What you're looking at is a true market powerhouse. You've got that unmatched scale of a 4.4 million horsepower fleet. You've got a commanding presence all across the US map. You've got that incredible secret weapon, an internal supply chain. And the whole thing is built on a stronger, more solid financial foundation. That's a winning combination.
And you know who else thought so? The market. The stock price held up great when the news dropped, and financial analysts were pretty much all singing its praises. They used phrases like significantly accretive and pointed out how it strengthens the company for the long run. It was a huge validation of the entire strategy.
So, in the end, this $860 million deal was really a masterclass in how to do an acquisition right. USCC understood that they weren't just buying another company's assets, they were buying capabilities. Which, of course, leaves us with one final very important question. With its own manufacturing power and a scale that nobody can touch, has USCC Compression just built a truly unbeatable moat around its business?